Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We've got a great show for you this morning, and as always, if you have questions about your portfolio, retirement, or any financial concerns, send those to Brian Rezny at ReznyWealth.com. And do make sure you visit our website, ReznyWealth.com. Download any of our groundbreaking reports. We newly released the 3 biggest risks you must avoid now as an investor. If you're a pre-retiree, a retiree, you have at least a $500,000 portfolio or greater, this is a must-read report. We covered the 3 biggest pitfalls going into next year. So again, we're firmly into this year, but we're more concerned about next year. If you're at all concerned about your money, the advice you're getting, lack of returns, must-read report, go to ReznyWealth.com, click on the Special Reports tab for an instant download, and it's free. One of the topics I want to talk about today is really why investors don't make money and how you could potentially increase your return on your retirement portfolio so you could have a more secure retirement. Let's first talk about the worst enemy when it comes to building wealth. We've all heard it. A lot of people forget it, but I want to talk about it again. Emotions and greed. That is the number one stumbling block for your financial security. I've been managing money for over 30 years. And I will say, and this doesn't happen often at our firm, we even see from time to time an occasional investor that we manage money for become emotional. They read some crazy stuff on the internet. They listen to hyped up headlines on the media shows, and they react to these, and it costs them a lot of money. And I've talked about that on previous shows. And again, it doesn't happen often at our firm because we do a pretty good job educating our clients and really bringing on clients that can hold some of that emotion back. But if you're at all an emotional investor, if you're shooting from the hip, if you read crazy headlines and you react to that, if you think the world's going to come to an end because a Democrat got in versus a Republican or vice versa, you're probably making really lackluster returns, and that needs to stop. The other big one is a lack of investment strategy. Again, managing money for over 30 years taught me one thing. If you don't follow a disciplined strategy, you have little chance to make a decent return on your money, and you ultimately create more risk in your portfolio. So do you have a strategy? Is it backed up by research? Do you have a buy strategy and a sell strategy built into that overall investment strategy? Most people do not. If you're a self-managed investor, I'll guarantee you have no strategy at all. You're buying what's hot, what big name company's out. It's Apple, so I'm going to buy Apple. But you haven't done any real research. You don't do daily research. You don't follow a buy and sell discipline, and I'll guarantee your returns are probably pretty lackluster. That's been proven time and time again by the Delbar study for over 3 decades. If you're working with a big Wall Street style firm or bank, again, what do they push on all you investors? Asset allocation, buy and hold, set it and forget it. And a lot of you out there are starting to realize set it and forget it, buy and hold simply doesn't work. The other big stumbling block is chasing what is hot after the big run-up. I remember back in 2000, and I was managing money back then, when we would get calls from new potential clients or even existing clients, and they would say, how come we don't own any of these tech stocks? It went up 300% last week. And again, things that are going up for no apparent reason, based upon no earnings and no real research, isn't a reason to buy a stock. But investors like to buy what's hot. I'll give you a great example. If you only had 2 investments in your portfolio, 50% in one, 50% in another, and let's say last year in 2020, investment number 1 made 20%, investment number 2 only made 5%. And you had an additional $100,000 to invest, 99% of investors would take that $100,000 and put it into the investment that did 20%, not the one that did 5%, because one did better than the other. And now this year, the one that did 20 is actually down 5, and the one that only made 5 is up 20. And unfortunately, that's not a guarantee how it works, but things that are of good value that should go up but lag are often a great place to deploy new capital if your research and the thesis for buying that still exists. There's no free lunch when it comes to risk. And one of the things that I try to educate every investor, and we get a lot of you that call our office that were suckered into buying one of these equity index annuities or annuities in general. You think you're going to get a free money bonus. You think you're going to make 8% returns at no risk. You're going to make lousy returns or lose money at best. You're going to insanely lock your money up in these programs, and you're not really getting free money. It's fake money added onto the back end, and the only way to get it is to annuitize a really crummy annuity. But investors who tend to be more emotional, or they think they're risk adverse, like to buy these annuities for all the wrong reasons without any real research. You listen to a sales pitch. If you got caught up into annuities, I suggest you go to ReznyWealth.com, click on that special report tab at the top, and download for free Why Annuities Are Dangerous to Your Wealth and Your Retirement. Read it twice, educate yourself, and if at some point you realize you made a major mistake, give our office a call, see if we can help manage your money properly and get you out of the mess that you're currently in. Most investors invest conservatively, but then get risky when the run-up happens. So again, this is another problem. Investors might say, well, I want to be a little more cautious. I'm not trying to make higher growth returns. But when everything's really rosy and they realize, wow, I only make 6%. If I would have done this, I would have made 12%. After the run-up, they want to then increase risk. That's the wrong time. If you are more conservative, stay conservative through the path of your portfolio and your retirement. If you don't mind taking on a little bit more inter-year volatility to have the opportunity for better returns, then maybe be more of a moderate or growth investor. But if you want to increase your risk profile, do it when things are down, because you want to buy more when it's down, when things are cheap, versus when everything is lofty and exciting. But people unfortunately don't do that either. Reversion to the mean. That kind of comes into play with my last comment. Reversion to the mean is if you have, let's say the market overall goes up 8% this year, but you've got a couple stocks that went up 15%, realistically the next year they'll probably lag and kind of average out. So the overall return over that 2 years is that 8%, let's say, that the market produced. It's called reversion to the mean. Anything that goes up too parabolic, too fast, often will then lag the next year and kind of come down and then equal itself out. But again, people will chase what's hot and they'll put it in the portfolio. The other problem, and I talked about this earlier, is called set it and forget it asset allocation. This is pushed by Wall Street firms, banks, and insurance companies. 90% of you out there listening today have what's called asset allocation. If you're working with any bank, Wall Street style firm, or insurance company, you probably have stock asset allocation. You've got this big pie chart that's got 42 pieces of pie in it, divvied up, a little bit here, a little bit there. A lot of this stuff doesn't make sense, but that so-called advisor is going to say, we need to be diversified. You need to be diversified properly. Owning 42 asset categories, and half of them don't make sense in the current economic environment, in an asset allocation pie makes no sense. At Rezny Wealth Management, we believe in active management, making adjustments to portfolios when necessary, and properly diversifying the portfolio, not overly diversifying and buying all assets, half that don't make any sense at all. That's a recipe for mediocre and an unhappy client. If you are doing stock asset allocation, which most of you are probably at a big firm, you're probably seeing lackluster returns and you're still seeing a lot of volatility. One of the last points before I take a break: hire a real fee-only fiduciary money manager to manage your wealth, not an advisor. A real fee-only fiduciary, fee-only means the only way they're compensated is by the fee you paid them to manage your money. Money manager, they actually manage your money. An advisor doesn't manage your money. They're selling the firm's money management services of other people, chances are. Fiduciary means they work for you legally 100% of the time. That is vitally important. If you don't understand fiduciary, fee only, and you want to protect your money from bad advice, go to ReznyWealth.com, click on the special reports tab for free. You can download Real Advisor, Fake Advisor. Read it. It'll discuss the difference between a real advisor, money manager, and a fake advisor, a salesperson. I'm going to take a quick break. Go to ReznyWealth.com. I'll be right back with questions after this. Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report radio and TV show. I've just released a groundbreaking report, the 3 biggest risks you must avoid now. I've covered the major risks that create financial ruins for many retirees. If you're at all questioning the advice you're receiving, this is a must-read report. Go to ReznyWealth.com for your free copy. Educate yourself, protect your retirement and portfolio. And we're back, and I hope you're enjoying today's program. And as always, send your questions to Brian Rezny at ReznyWealth.com. I think it's vitally important, whether you're a retiree, pre-retiree, and you have any kind of doubts or concerns about the advice you're getting, or maybe some of the investments in your portfolio just don't seem right. It's easy to get that second opinion on my radio or TV show, so send them to Brian Rezny at ReznyWealth.com. Kate in Naples, Florida. Where is Amazon stock? Where could it be in the next, say, 5 years? Kate, great question. I like Amazon. We own positions in that within the portfolio, just a fair disclosure. But I will say this, Amazon is quite pricey at its current point. I think Amazon's going to be a dominant player. They're putting their tentacles into a lot of different things for growth, which I think is an opportunity. But this is a stock that trades well over 60 on the PE ratio. The average PE on the S&P 500, as an example, is about 18 versus over 60. That's a huge difference. You're talking over a threefold increase in price. I like the stock. Valuation's getting a little stretched. So what I would say is this. I think the stock could be potentially a laggard to some extent in a portfolio. So if you do own it, do your research daily and trim your position if it gets well over, let's say, a 1 to 2% weighting of your overall portfolio. Jeff in Fort Myers, Florida. You mentioned ARK investments. What do you think of adding to my AARK position? I am not a fan of the ARK ETF family of funds. And the reason I'm not is they tend to buy a lot of these really go-go stocks within their ETF. A lot of you may or may not remember, but we had obviously COVID a few years back. The ARK family of funds had these incredible returns because a lot of the stuff they owned raced up 120, 150%. It was actually one of the best performing ETFs of that time frame of 2020, only to get then clobbered the next couple years and come back to earth. So the average return the last 3-4 years is actually not great at all. But people jumped into that ETF because of the lofty returns that they saw the year before. Again, that was one of my cardinal mistakes that I showed earlier in today's program. I don't like those ETFs. I would rather be a little bit more cautious and better diversified and less go-go octane. And I think you'll be a better off investor. Steady Eddie wins the race. Ones that basically eat too much at the buffet gain a lot of weight and they die early, I guess is a good way to put it. Jim in Port Charlotte, Florida. Vanguard Real Estate ETF, VNQ, as an investment. What I would say right now is this. The real estate market, traded REITs, which that is. I would stay away from real estate at this point. With interest rates being where they're at, with a lot of the problems going on in commercial real estate and some of the banking sector, I think one of the areas that I would avoid right now is real estate. Now, there may be a time for VNQ, maybe in a year, 2 or 3, when the final bloodletting of the commercial real estate market kind of is done. But I think we've got some more bleeding to go, and I think we've got some more downside. I would avoid real estate and traded REITs altogether, and I would wait for lower prices in the next 1 to 3 years. It's one of those investments that you keep on the side and you watch daily for a buy point. Now is not the time to be in that type of an investment. Pete in Cape Coral, Florida. What do you think of the electric car makers and Tesla? Generally speaking, I think Tesla's a great company. It's overvalued, though. It trades at a really high multiple. All the car companies, every car company in the world, are all making EV cars or hydrogen type cars, or working on this currently. So car companies are usually bad businesses to invest in long term because they are very capital intense. They're very low margin. Their profitability is here and there and gone tomorrow. You have a recession, the stocks collapse. If you look at any of the major car companies around the world, they've done very poorly the last decade in return, even the last 5 years, even the last 20. Tesla's Tesla, it's a car company, but people are buying it because it's Tesla without any understanding of their earnings, their valuation, but they're buying it because it's Tesla. Again, eventually that stock is going to do poorly and a lot of investors are going to lose a lot of money. It may go up in the meantime, but that's not the reason you buy an investment. You buy an investment because it's got good fundamentals, a good future growth story, it's got the valuation that is needed, and that is built into your buy point. Lynn in Punta Gorda, Florida. Amgen, is it a good investment? I actually like Amgen as a company. I think one of the issues you're going to have if you buy single stock, especially in the kind of that biotech, let's say, medical drug area, you can have a lot of whipsaw. You might want to look at an ETF instead so you're more diversified, something like the XLV, which, fair disclosure, we own in our managed accounts at Rezny Wealth Management. I like the healthcare and the medical side a lot. I think valuations are very reasonable, but if you're going to play it and you want to have it as a part of your portfolio, I think the XLV would be a better place to be. Better diversification. You're going to own a better diversified portfolio of high quality names in the medical side, which I think ultimately can give you a much better upside potential in your portfolio. Carol in Naples, Florida. My husband recently passed and handled all the financials. I now need help and don't know where to turn for competent help. Carol, what you want to do is you want to hire what's called a fee-only fiduciary money management firm, like Rezny Wealth Management. We are taking new clients at our firm. Our current client minimum to start is $500,000 and greater. We work with a lot of people where they've lost a husband or wife or couples. Our client base is predominantly pre-retirees and retirees. Our clients come to us because they've already been at the Wall Street firm, the banker, the insurance company, and they were sickened by the conflicts, the bad advice, and really just the mediocre service they received. So if you want real advice and real money management, I suggest you call our office during the week. That's 800-618-8577. You can also, Carol, go to ReznyWealth.com. Click on the special reports tab and download for free so you know how to pick a real money manager. A real advisor, fake advisor report. It's free. It's an instant download. It'll educate you what you should be doing and not doing when you're looking for an advisor, a money manager, and how to really pick a quality firm versus a Wall Street style firm that's conflicted, conflicts against you, cost structure is crazy. And really, these firms sell products they're required to sell, that they manufacture, that their advisors really are acting as really customer service reps more than any kind of advisor at all. I think investors, unfortunately, don't do their homework when it comes to picking an advisor or money manager. That report will seriously help you in your quest for real advice and real money management. I'm going to take a quick break. I'll be back with more questions. Send those to Brian Rezny at ReznyWealth.com, and make sure you go to our website, ReznyWealth.com. Click on that special reports tab. Our #1 downloaded report so far this year, which is a must-read. 3 biggest risks you must avoid now if you're trying to create financial security, if you're trying to avoid the conflicts of bad advice, if you're trying to reduce the risk in your portfolio by not being sold crummy investments by a so-called advisor. This is a must-read report. Again, go to ReznyWealth.com, click on that special reports tab, instant download. The 3 biggest risks you must avoid now. Perfect for retirees and retirees alike. I'm going to take that break, and again, I'll be right back after this. Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report radio and TV show. I've just released a groundbreaking report, the 3 biggest risks you must avoid now. I've covered the major risks that create financial ruins for many retirees. If you're at all questioning the advice you're receiving, this is a must-read report. Go to ReznyWealth.com for your free copy. Educate yourself, protect your retirement and portfolio. Tom in Naples, Florida. I talked to my lawyer about an irrevocable trust to protect my assets and my estate. Long-term nursing home cost. What do you think about trust? Tom, what I've seen, I'd say in the last 3 or 4 years, there's a number of attorneys who are jumping on these irrevocable trust bandwagon. And they're selling these over-expensive trusts that simply are not going to work in our opinion. They're really marketers. They're not acting as estate planning attorneys. They're selling an irrevocable trust that should cost a couple thousand for $10,000. But let me explain. If you take your money and you put it into an irrevocable trust, you lose full control, Tom, of all your money. All control of your money. You have to have an independent third party as trustee. It can't be a family member. I've had a few clients that called me that went to some of these free steak dinner presentations about irrevocable trusts, and they said, what do you think about this? I said, your kid cannot be the trustee. Because really, if you look at some of the Florida statutes, it would negate the viability of that irrevocable trust. So ask yourself, Tom, do you want to lose complete control of your assets? Probably not. Do you want to have some independent person to trust you over your money? Probably not. So what I would say is this. You probably won't be going to a nursing home. Your spouse probably won't go to a nursing home. In fact, most people, if they go into a nursing home, the average person probably stays in there 3 to 6 months. That's it. Is it going to spend all your money? Probably not. Do better research. Don't fall for a sales pitch. Unfortunately, there's a lot of attorneys now that are becoming salespeople for these crazy trusts that are ineffective or overpriced, or they're starting to sell annuities and insurance policies in addition. Mark in Fort Myers, Florida. Are utility stock a safe investment? Utilities are not safe and they're not risky. They're investments. Utility stocks are like any other stock. They can go up, they can go down a lot. And what's happened is because their dividend stream on a lot of utilities are a little bit higher than the average, let's say for the S&P 500, people have more gravitated towards those in order to maybe get a little bit higher dividend stream. I would say a lot of the utilities are fairly overpriced. I do like a lot of the utilities, but price does matter. So what I would say is I think there's better places, given how we're looking at this economy transition come out into potentially a soft landing the second half of this year. I would really avoid utilities. I would look for other areas that are better opportunities. You might want to look at the oil sector because I think there's an area there for long term, the next 3 to 5 years. I think oil prices are potentially going higher, and I think it could be an opportunity investment for a lot of you. But again, do your own homework. Carl in Fort Myers, Florida. Our advisor is telling us to sell our mutual funds and invest in a variable annuity for tax saving and asset protection. What are your thoughts? Carl, your advisor is a salesperson. They're not a fee-only fiduciary money manager. They're trying to sell you an annuity. Anybody who sells annuities is not a fee-only fiduciary money manager. Your advisor is not legally working in your best interest as a fiduciary when they sell you an annuity. They're actually working against you. By selling your mutual funds, you're going to pay tax on your mutual fund gain. You're then going to put it into a variable annuity that could have annual cost, get this, of 3.5 to 4.5 every single year. 3.5 to 4.5% every single year. The average mutual fund might have a cost structure of 75 basis points. So you're going to go from that to 3 or 4 times more in cost structure, and you're not going to save money in taxes. When you take money out of a variable annuity, you pay taxes at ordinary income rates, not capital gain rates. So your advisor is selling you smoke and mirrors. It's going to cost you a bunch of taxes to get in. You're going to pay more taxes when you buy the annuity. You're going to pay higher expenses over 4 times probably what you're paying now. Your returns are going to be lousy. You're going to get disgruntled. Don't do it. What I would suggest is call my firm for a consultation. We do manage larger portfolios. So if you're tired of the runaround of a so-called advisor, you want real money management without the conflicts of Wall Street banks and insurance companies, come to Rezny Wealth Management. Go to ReznyWealth.com, and by the way, Carl, for free, why annuities are dangerous to your wealth and retirement. It's a free report. It's on my site. Read it. Educate yourself. Avoid that bad advice you're being handed. Sue in Cape Coral, Florida. My husband and I bought 3 annuities 5 years ago for retirement. In 5 years, we've made roughly 6% total. We were told we would make stock market returns and have no risk. Now we realize we are spending our principal and we will be in trouble shortly. What can we do? Unfortunately, you were sold these annuities, and we get lots of calls on my TV and radio show, people just like you. Disgruntled, angry, mad. If you stay in the annuities and you're now spending down principal, you have a big chance of running out of money because your money is not making any money. In 5 years, you made 6%. You made a little over 1% a year. You're so far under inflation and a real return, it's sickening. Your advisor is really a salesperson selling annuities. You've got a number of options, but you need somebody who understands those options. Option one is you could take your 10% penalty out and reinvest it in real investments. Option two, you could take your 10% penalty out and an additional invested in real investments. Find a fee-only fiduciary money manager. Option three, say, hey, we made a mistake. Pay the penalty, take the money out, and invest it in real investments. Think about this. If you're 65 or 70, you got 20, 25 years ahead of you in retirement. One of you will live in your 90s, chances are. And if you keep making 6% and you're already drawn down principal fast, you could be out of money in 6, 7 years. Do you want to go back as a Walmart greeter at the age of 75? Probably not. Again, go to ReznyWealth.com, like I suggested to our last question. Download the report, Why Annuities Are Dangerous to Your Wealth and Retirement. Unfortunately, people get duped into these annuities all the time. They're lied to, they're mishandled, there are all these promises of this grandeur of returns and or free money bonuses. None of these things are factually true. You're dealing with people that are licensed in a minimal way, loosely regulated at best, and unfortunately, this unsuspecting investor is the brunt of this bad sales job. Ted in Boca Raton, Florida. My brother-in-law handles our investments and has done a lousy job, to be frank. The problem is breaking off the relationship for greener pastures help. You know, Ted, bottom line, it's your money. If your brother-in-law is doing a bad job, and we get a lot of these clients, by the way, that'll come to us, it's my brother-in-law, Bob, at the big firm. Nice guy, doing a lousy job. How long are you going to let your brother-in-law do a lousy job? You can't keep doing that. You've got to move on. At the end of the day, it's your money. If he's doing a lousy job, he needs to be fired, and you need to find greener pastures. Go to ReznyWealth.com. You're more than welcome to give us a call during the week. Download any of our groundbreaking reports on the Special Reports tab. Read them, educate yourself. Vitally important that you, the investor, take charge. It doesn't mean you have to manage your own money, but at least find a real money management firm that legally works for you and actively manages your money based upon your goals and objectives. That would be Rezny Wealth Management. If you're tired of set it and forget it, if you're tired of that bad advice, if you're tired of bad client communication, give us a call during the week. We would love to help you with your portfolio and get you back on track. Never settle for bad advice or conflicts that undermine your financial security. You do not have to. Sad fact, most advisors are really salespeople that are selling products for the firm they work for. Rezny Wealth Management, fee-only fiduciary money management, real money management. We actually manage your wealth. We have great client communication. We can help you with your long-term retirement planning and keep you on track. Make sure you have yourself a safe and profitable day.